Welcome to this deep dive. Today, we're cracking open Frank Tian's Consumer Credit Newsletter. It's dated June 15, 2025.
Right.
But we're not just doing a news recap here. We really want to connect the dots, understand these, well, seismic shifts happening in finance.
Yeah, it feels like things are moving fast.
Totally. So our mission is to cut through that noise, show you how this new finance is merging with the old stuff. Data bureaus, card networks, even digital currencies. It's really your shortcut to, well, being properly informed in this landscape that's changing so quickly.
And that word you used, merging, or maybe convergence.
Yeah.
That's absolutely the key theme, isn't it?
Exactly, convergence.
We're seeing these different bits of the financial world, things that used to operate, pretty separately.
Yeah, in their own lanes.
Right. Now they're intertwining, sometimes in really surprising ways. So today we'll explore those connections, big regulatory changes, like with Wells Fargo.
That's a big one.
How your credit score might get looked at differently, and yeah, the growing influence of crypto on traditional markets.
It feels like they're all connected.
They really are. It's fascinating how these sort of seemingly separate things are all pieces of this bigger story that's shaping, well, the future of consumer finance for everyone.
Okay, so let's kick off with that big headline. It's been, what, nearly 10 years coming?
Yeah.
Wells Fargo finally having its asset cap lifted.
Yeah, a huge deal.
It all stems from that, well, infamous fake account scandal back in 2016. It's become a real case study, hasn't it? A lesson in financial history.
It truly has. And that asset cap, the Fed put that on in 2018, froze their growth, basically, at $1.95 trillion.
Wow.
And this wasn't just, a slap on the wrist. It fundamentally reshaped their consumer lending side.
Right.
It makes you ask, what does a metrics-driven culture really mean? And how did it push things to, well, dangerous extremes like it did back then?
Yeah.
The lesson here isn't just about the penalty itself, huge as it was, but that long-term impact on the bank's strategy, its whole identity almost.
And the scale of that impact. I mean, think about it. They sold off $10 billion in student loans in 2020. Then they exited a massive $70 billion correspondent mortgage business in 2023.
Huge businesses.
Yeah. And they even tried, remember, to shut down personal credit lines between 2020 and 2021. That failed pretty spectacularly.
Oh, yeah, I remember that. Yeah.
And on top of that, exiting co-branded cards. Dillard's moved to Citi, and then even sued Wells Fargo last year over the switch.
It's just one thing after another, a staggering amount of disruption.
Definitely.
So while lifting the cap, marks a new chapter for them, the deeper takeaway for all financial institutions seems pretty clear.
Which is?
Well, that ignoring the need for a balanced culture, for strong risk controls, it just comes at a monumental cost. It really highlights how crucial internal safeguards are, maybe even more than just the external regulations.
Good point. It wasn't just about money, it was about their whole way of operating.
Exactly. Their operational DNA, as you say.
Okay, so moving from a traditional giant like Wells Fargo, let's talk about the heart of everyday transactions, the big credit card networks.
Right. Visa, MasterCard.
They're expanding way beyond just the plastic in your wallet. They're embracing totally new ways to pay. It's actually pretty exciting.
Absolutely. Look at MasterCard and Deutsche Bank. They're teaming up to deliver open banking and account-to-account payments, A2A, they call it.
A2A, right, across Europe.
Yeah, across Europe. They're integrating MasterCard's open banking tech, so merchants can offer real-time pay-by-bank options.
How does that work exactly?
It uses something called request to pay, or R2P. Think of it like a digital invoice or bill request.
Okay.
That lets you, the consumer, approve a payment directly from your bank account instantly.
So faster settlement for merchants.
Exactly. Faster settlement, more flexibility for everyone. It's a pretty big step beyond just the traditional card rails.
And Visa's doing something similar.
Very similar path. They've launched their own pay-by-bank service, Visa A2A, over in the UK already, tapping into that growing market.
Faster payments, I assume.
Yep, real-time settlement via faster payments. Plus, crucially, they're offering card-like protections and more control for consumers. So it feels familiar, but it's actually a different mechanism.
Interesting. So they're adapting.
Well, that's the strategic part, right? How they're adapting to what consumers actually want now. At Money 2020 Europe recently, Visa announced partnerships with Klarna and Zilch.
Oh, yeah, the BNPL players.
Exactly. To launch flexible debit cards that integrate buy now, pay later features.
So like a debit card that lets you pay in installments.
Pretty much. Klarna's card, it's FDIC insured, supports pay in for and pay later. Zilch's card, also Visa-backed, lets you literally toggle between paying now like debit, using it like credit, or deferring the payment.
Wow, that is flexible.
It really is. It's not just about offering more choices. It feels like a really shrewd move. They're future-proofing themselves as traditional cards face more competition from, direct bank payments, embedded finance.
Turning competitors into partners almost.
Precisely. It's a very consumer-centric, flexible, multi-rail strategy, you could say, keeping them relevant.
Okay, that makes sense. Now, let's dive into how credit itself, how we assess it, is changing.
Right. The old world meets the new.
Yeah, the world of credit bureaus is sort of shaking hands with open banking data.
Yeah.
And it looks like it's creating some powerful new tools for lenders.
This is a really major shift, I think. Experian has partnered up with Plaid.
Plaid, okay, the data aggregator.
Right. To seamlessly pull in what they call consumer permissioned banking data right into credit assessments.
So data I agree to share for my bank account.
Exactly. This boosts Experian's existing cash flow insights product, which already uses cash flow data from bank accounts for scoring. The Plaid partnership just makes getting that data smoother, much more scalable for lenders.
So what does that actually mean for, like, my financial profile?
Well, it means your actual spending habits, your saving patterns, how reliably you pay bills. Stuff seen directly in your bank account becomes a more direct factor in deciding your creditworthiness.
Which seems fair, in a way. More real time.
Potentially, yeah. Historically, lenders often had to pick, right? Use the traditional bureau score or use this new open banking data.
Right, it was like an either.
But now that convergence is happening, lenders want both. It's a clear sign that maybe they felt they were missing opportunities.
Missed acquisition opportunities, yeah.
And that's driving these partnerships. It's less about choosing a lane, more like building a data superhighway, as you put it earlier.
Yeah, a superhighway, I like that.
And the potential impact is pretty big. Experian says this open banking data can boost score predictiveness by up to 25%.
25%, that's significant.
It is. And we're seeing Fair Isaac, FICO using this data globally too, especially in the UK, trying to expand access and accuracy.
Right.
Plus, with the newer Vantage Score 4 Plus, Stan, lenders can even ask for extra banking data to rescore an applicant if they were initially denied.
Oh, interesting, like a second look.
Exactly, potentially offering a genuine second chance at approval for some people. It allows for a much more holistic view of someone's financial health beyond just past credit history.
Okay, fascinating stuff. Let's pivot now to the digital frontier. Stablecoins.
Ah, yes, stablecoins. Still very hot.
Sizzling hot, yeah. But their growing links to traditional finance, or TradFI, that comes with some, well, important things to consider.
It certainly does. The Financial Stability Board, the FSB, they're actually warning that crypto's ties to traditional finance are getting close to a tipping point.
A tipping point. That sounds serious.
Yeah, the outgoing chair, Klaas Knott, he specifically pointed to things like growing retail access through ETFs.
Like the Bitcoin ETFs.
Right, and also the huge amounts of U.S. treasuries that stablecoin issuers hold now. Those are key areas to watch.
So it's not systemic risk yet, but it's growing.
Exactly. It's escalating, and it demands closer oversight. And the scale is just... Wow. Stablecoins now have a market cap around $251 billion.
$250 billion. And it's not just hypothetical impact, right? There was that BIS study.
That's right, the Bank for International Settlements. They found stablecoin inflows can actually push down short-term U.S. Treasury yields by maybe 2.5 basis points?
Okay, a small effect, but measurable.
Measurable, yeah. And outflows can raise yields by maybe 6-8 basis points.
Oh, okay.
And they found USDT and USDC had the biggest effects, especially on 3-month treasuries.
So that's a direct ripple effect on the bedrock of the traditional system from crypto.
It is. It's subtle, but it's significant. It shows DeFi liquidity directly influencing, the U.S. Treasury market. Yeah. That's a clear sign of how tangled these worlds are getting, even without full regulation yet.
And investors seem confident. Circle's IPO.
Yeah, Circle, the second biggest stablecoin issuer after Tether, they had a strong public debut June 5th. Shares trading around $110, way above the $31 issue price.
That definitely signals strong investor belief.
It does, and maybe even more telling, JP Morgan, who actually helped run the Circle IPO, they're now going to accept spot Bitcoin ETFs like BlackRock's IBIT as collateral for loans.
Get out, JP Morgan. Really?
Yep. Global move applies to retail and institutional clients. It's a really notable policy shift for them, especially under Jamie Dimon, who's, historically been pretty skeptical about crypto.
Wow. Okay, the worlds are definitely converging there.
No question.
Okay, let's shift again. There's this surprising piece of research really challenges a common idea about overdrafts.
Ah, the New York Fed study. Yeah, that one's really interesting.
It basically sheds light on who actually overdrafts and why. And it kind of overturns that idea that it's mainly low-income or minority households footing the bill for overdraft fees.
It's a fascinating insight. I mean, yes, those groups do overdraft more often statistically,
Right.
but this study found something critical. It found that your credit score, not your income, not your education level, not your race, is the single most reliable predictor of whether you'll overdraft.
Credit score, more than income.
More than income, yeah. It fundamentally reshapes how we should maybe think about financial vulnerability. They surveyed about 1,000 U.S. households. People with scores below 620 were over 50% more likely to overdraft than people with scores above 760.
Okay, clear correlation then.
Very clear.
Yeah.
And the frequency of overdrafting also went down as credit scores went up. It shows a direct link between being credit constrained and relying on overdrafts.
And here's the part that really blew my mind.
Go on.
Once you account for the credit score, those other factors, income, race, they basically lose their predictive power.
It's pretty striking, isn't it?
Yeah. So low-income folks are not significantly more likely to overdraft than higher-income folks if they have similar credit scores. Same for minority versus white respondents.
Right. It levels the playing field once credit risk is factored in.
And even education. It was weird. Among people who did overdraft, those with just a high school diploma overdrafted less often than those with graduate degrees once you control for that credit risk.
Which really turns conventional wisdom on its head. So what does this all mean? For policy, for understanding hardship, it's pretty profound, I think.
Yeah.
It completely reframes the whole overdraft debate. It's not just about who you are demographically. It's fundamentally about how constrained your access to credit is. If you can't easily get traditional credit when you're in a tight spot.
You're more likely to dip into overdraft.
Exactly. It makes a powerful case for thinking about broader credit access, not just focusing on regulating the fees themselves.
That's a really important distinction.
Wow.
Okay.
Yeah.
All right, so to wrap up our deep dive today, let's hit a few other quick takes, some notable developments shaping consumer finance.
Sounds good. Lightning round.
Kind of. First up, Wealthsimple, Toronto-based neobank,
Okay.
making some big moves. They just announced their first 2% cashback credit card, plus an upcoming low-rate instant line of credit.
Expanding their offerings.
Yeah, but get this. They're also launching branchless services like check and cash delivery, wire transfers, bank drafts, basically bringing the bank to your house.
Wow, that's really leaning into the neo part of neobank. Full service, but totally digital first.
Exactly. Okay, next. Get ready for a reunion. Walmart and Synchrony.
Synchrony. They used to do Walmart's cards, didn't they? Ages ago.
Exactly. Nearly 20 years they were apart. They split in 2018. Walmart went with Capital One.
Right, I remember that switch.
Apparently, that partnership didn't quite work out as planned.
Yeah.
So Walmart realized how valuable Synchrony actually was. They'd helped grow the card program to $10 billion.
$10 billion. Okay, yeah, that's value.
So Walmart's going back. The duo is relaunching credit cards through Walmart's fintech startup, OnePay, this fall.
Huh, it's like getting the band back together. Interesting.
Totally. Okay, and finally, this one sounds like sci-fi, the AI CEO.
Uh-oh, what now?
Klarna. They've launched an AI CEO hotline. You can call up and talk to a digital twin of their CEO, Sebastian Siemiatkowski.
Seriously, a digital twin?
Yep. Trained on his voice, his insights, the AI takes product feedback, answers questions, and sends the transcripts to the actual product teams.
Huh, that's the novel. A bit creepy.
Maybe a little. But in a twist, Klarna also recently scaled back its overall AI strategy a bit. They reaffirmed the value of, actual human staff.
Ah, okay. So the robots aren't taking over just yet?
Not quite yet. Your boss is probably still human for now.
Good to know.
Phew. Okay, what a deep dive that was into this accelerating convergence in finance.
Yeah, a lot covered.
From Wells Fargo's long, hard road back to card networks thinking way beyond plastic, and those really surprising findings about overdrafts being tied so closely to credit risk, not just income.
Yeah.
It's just clear the whole world of consumer finance is evolving incredibly fast.
It really is. And if you connect those dots like we tried to,
Yeah.
you see this clear trend. More flexibility for you, the consumer.
Yeah.
Deeper, more complex use of data in financial decisions. And this constant blending of traditional and digital systems.
Right.
Looking at Frank Tian's newsletter this way really highlights how interconnected it all is. And ultimately, it feels like it's all aiming to make finance maybe more responsive, more accessible.
hopefully. More responsive and accessible in new ways.
Yeah.
So here's something to think about as you go about your day. With data playing this increasingly predictive role in who gets access to what, and those lines between traditional and digital finance getting blurrier all the time, how might this new finance fundamentally change the way you manage your money? And maybe even how you think about your own financial identity in the years ahead.
That's the big question, isn't it? Food for thought.